Hello and welcome to Money Markets and More with me, Dominic Frisby. I normally do these videos walking and talking, as you know, but today I went out twice today and both times my phone ran out of battery. So I'm doing today's video from my office and I hope you don't mind. We are talking gold, my favourite subject, or one of my favourite subjects, and we are asking how high can it go? Now, gold had an epic bull run in the noughties. I still remember the key numbers like it was yesterday. There was the low in 1999, $250 an ounce, marked for all eternity by the Chancellor of the Exchequer back then, Gordon Brown, as he sold off 2/3 of British gold at the bottom of the market when there was no compelling need to sell. That was Brown's bottom, and that bottom was retested in 2001. We got a classic double bottom, a double buttock, followed by 8 years of bull market, which ended up, well, there was a big wobble in 2006, but it ended in 2008 at 1,030 an ounce. And then the global financial crisis came along. Gold plummeted along with everything else. An unstoppable rebound lasting 3 more years followed. First, the gold price broke out to new highs, and then on it marched until eventually it peaked in 2011 with the Greek debt crisis at 1920 an ounce. And then came the bear market, 5 brutal years of pain. It went all the way back to 1,040 an ounce. In more recent years, the period between 2018 and 2020 saw gold rally again. It went north of $2,000 an ounce, albeit briefly. But here we are in early 2023, and guess what? As I write, gold sits at 1920 an ounce, the same price it was back in 2011. Markets remember prices. Historical highs and lows are like magnets. So will it pull back from here? Maybe. Probably. It's rallied $300 in barely 2 months. It's overbought. Neither silver nor the miners are leading. That's usually not a good sign. Charlie Morris, my old buddy Charlie, says gold is trading above fair value. Charlie Morris is usually right. Now, you can get cute and you can try and trade it, but no one knows what's going to happen. It's a precious metal and it's a market. If they can throw you, they will. Gold usually does well when trust in financial markets is low. I'd say that was the case now. But do you risk your position in the hope that you can get back in lower? What if it goes up instead? Or you can take the longer term view. A lot of physical holders do this, like the famed trader in Old Partridge, in Edwin Lefebvre's Reminiscences of a Stock Operator. Brilliant book if you haven't read it. This was an old boy who never wanted to lose his position in a bull market. And he would always say, it's a bull market. And that's a view that's since been echoed by the memed typo, you can just hodl on. We've all got to make our own choices, learn from them, and live with them. But here is the main focus of today's piece. It's a nice little thought experiment. I've heard it before, but I'd forgotten it. And it was brought to my attention again by Winston Miles of Canadian investment house 8 Capital. So there was a presentation by Grant Williams, the strategist Grant Williams, in 2016 called What If? And he asked, what would happen if pension funds, which currently had a 0.15% weighting to gold, increased that allocation? And so Miles decided to run that scenario in today's marketplace. And these are his words. According to the OECD's most recent global data, global pension assets are 56 trillion. I could easily see pension funds getting up to 1% of their portfolio in precious metals on average. But let's be a bit more conservative and go with 2/3 or 1% or 66 basis points, which would be $374 billion. That amount of money, he says, could buy every single company that makes up the Philadelphia Gold and Silver Index. That's the major gold and silver index. That would set them back just under 300 billion. Then they could buy every share of GLD, even taking delivery of all that gold if they wanted. GLD is the main ETF. It's all sitting in a vault somewhere. That would cost another 56 billion. Then, with the scraps left over, they could buy every share of GDX, GDXJ, SIL, and the SILJ. Those are the gold and silver mining ETFs. So this is me talking again now. In short, there is a lot of money out there, and on a relative basis, there isn't a lot of tradable gold, and there aren't that many gold mining companies. A small shift in the narrative may stay as it is, but a small shift could send the gold and silver markets a long way higher. Miles again. It's an environment, he says, where almost no major pensions have a portfolio manager focused on metals and mining. The infrastructure is totally gone. It's hard to add supply, the mines are old, it takes 10 or more years to build new ones. These are really long lead time projects. That's why so few people invest in mines. It just takes so long before they make money. Now, you can conduct the same thought experiments with oil, gas, coal. This is me talking now. Very little allocation, largely because of ESG, and very little investment, leading to tight supply. And there are long lead times as well. You can conduct the same thought experiment with Bitcoin. What happens to the Bitcoin price if Bitcoin were to become a core mainstream portfolio holding? They'll all go a lot higher. Now, you cannot say the same about tech, Amazon, Google, the S&P 500, government bonds. They are all already owned. Now, the narratives for gold, fossil fuels or Bitcoin, they may not change. But if they do, look out above. And on that note, here's the S&P 500 relative to gold since 2000. And when this chart is rising, gold is rising faster than the stock market. Gold is outperforming the stock market, and vice versa. When it's falling, the stock market is outperforming gold. At $19.20 an ounce, gold is a lot cheaper today relative to the stock market than it was when it was $19.20 an ounce back in 2011. It's a third of the price. To get back to those equivalent levels, assuming no change in the price of the S&P 500, gold would have to triple. Now, I like the sound of $5,700 an ounce gold. Next, here are the gold miners relative to gold, and with the plethora of new ways that opened up to get exposure to gold in the noughties, ETFs, online bullion dealers, CFDs, spread bets, and all the rest of it, investors stopped bothering with miners. And who can blame them? Too much incompetence, too many frauds, too many political and environmental risks gone wrong, all the rest of it. And miners have been falling in price relative to gold since 2003, but they stopped falling in 2015, and since then they've gone sideways. They are, as the technicians say, building cores. I reckon the low is in. It came in 2015. We retested it last year. What do you think? Post your comments below. And if you're interested in gold miners, please consider becoming a paid subscriber to my Substack. I cover gold miners quite extensively. If you're buying gold, my current recommended bullion dealer is the Pure Gold Company in the UK. Whether you're taking delivery or you're storing online, premiums are low, the quality of service is high, and you can deal with a human being. I have an affiliation deal with them, and I'll post a link in the description below. And if you're buying Bitcoin, be sure to read my special report on Substack. I'll put a link in the description below to that too. Thank you very much for watching. Make your #1 resolution for 2023 to listen to Kisses on a Postcard, and I'll be back with another podcast very soon, another video very soon. Thank you very much for watching. Goodbye.